Hi everyone, welcome to LSBF TV. My name is Rijwana Uddin and I'm one of the tutors here at LSBF, and we are going to be going through Level 4 AAT assessment tasks. This particular paper is financial statements for limited companies. We'll be working through all of the tasks, giving you the confidence that you need to succeed in any of the exam questions. This first task will be relating to the preparation of financial statements. This could be statements of profit or loss, the statements of financial position, the statements of changes in equity, and the statement of cash flows. This particular task that we're going to cover today will be asking you to prepare the statement of cash flows. So come with me, grab a pen, some paper, and a calculator, and we can build the cash flow statement together. This task is where you've been asked to prepare a statement of cash flows and a statement of changes in equity for Chicago for the year ended 31st of December. Now today we're not going to cover the statements of changes in equity, we will do that in another session. Today we're purely going to concentrate on the build-up of a statement of cash flow. The most recent statements of profit or loss and recent statements of financial position with comparatives for the previous year of Chicago can be viewed below. So here we've got the statement of profit or loss for the year ended 31st of December 2011. We've got revenue, cost of sales, gross profit, profit on disposal of PPE. How do we make a profit on disposal? You would have learnt in your accounting studies that if you sell an asset for greater than its carrying amounts, that's classed as a profit on disposal. And such profit will be recognised as income on the statement of profit or loss. Whereas a loss on disposal is where you've sold the asset for less than what it's worth, and these are classed as expenses on the statement of profit or loss. We have distribution costs, we've got admin expenses. These are also known as operating expenses, and these represent money that you've incurred in order to generate or run your business on a daily basis. We have finance cost, which represents your interest charges based on the amounts that you've borrowed. And then we've got our tax expense. Our tax expense represents the expense relating to the amounts due to HMRC. We've got other comprehensive income, and other comprehensive income will relate to any gains on property revaluation. And we're explicitly told here that the OCI income is $7,000. Further information, total depreciation charge for the year was $4.992 million. Depreciation represents the amount of asset consumption that you have used to generate the economic benefits in your entity. As you're using the assets, it will also lose some of its value. So this is an application of the accruals concept, matching the income generated to the expense incurred for a particular period. The next bullet point we're told is that property, plant and equipment with a carrying amount of $543,000 was sold in the year. So we know that this entity made a profit on disposal, and the carrying amount of the disposed asset was $543,000. Number 3, land was revalued upwards during the year by £7 million. If you revalue a land, you're trying to match the market value to the book value, and the difference is you've had an uplift of £7 million in your asset property value. We've got all sales and purchases were on credit, which means that you have sold on credit or you've bought on credit, where the customer has taken the goods home with them today and promised to pay you at a later date. Other expenses were paid for in cash. And the final bullet point we've got here, a dividend of $4 million was paid during the year. If you pay your shareholders a dividend, this is going to be relating to money leaving the bank account. But what other impact would you see on the financial statements relating to dividend paid? In order to be successful in such accounting assessment task, you need to understand the format of the financial statements. Our videos here at LSBF are going to be talking about each financial statement and also trying to get these students to understand how to build these statements. we create real live examples to match what you would see in the real exam and work through those examples. Why not sign up to our AAT videos? The tutors are committed to help students be successful in any paper that they sit. To be successful in this question, let's have a go at what the examiner wants us to do. We've also been given the statement of financial position, and we've got the comparative figures, 2010 and 2011. Now these dates have an X which hides the decade, which means you can read them as however you want. You can read them as 2020 and 2021. Just understand that one of them represents a balance brought down, and the other is the balance carried down. So we have an opening balance at the period start and a closing balance at the period end. So this is balance carried down. Okay, so we have property, plant and equipment. We've got inventories, trade receivables, cash and cash equivalents. We've got the equity balances for share capital, share premium, revaluation surplus and retained earnings. Finishing off the statement of financial position, we've got our non-current and current liabilities, bank loans, trade payables, tax liabilities and bank overdraft. Part A of the question is for 13 marks. So I need to show the examiner that I am confident in preparing the cash flow statement and getting as many marks as possible. I know that this is my strength, so I will try to do this question first, get it out of the way so I can spend the remaining time doing other assessment tasks for the exam. Clearly, it says draft a reconciliation of the profit before tax to net cash from operating activities for Chicago for the year ended 31st of December 11. So we need to do the cash flows from operating activities. They want us to start off with the profit before tax and finish off with the net cash from operating activities. If you come with me on the next page, we've been given a blank pro forma for Chicago Limited and a reconciliation of profit before tax to net cash from operating activities. The main task here is to ensure that you are putting the numbers in the correct boxes, but also making sure you've got the right signs. You add if you want to increase a value of something and take away if you want to reduce the value of something. Many weak students are getting the plus or minus signs wrong. So allow me to tell you how we reconcile the profit before tax to the cash from operating activities. In this real assessment, you'll be getting options from a drop-down list. We've created a table so you can see all of the options outright, so your eyes can pick out the most important bits that you need. So if you can do such questions with me today, imagine what you can do on the day of the real exam. Okay, please fill in the empty left-hand boxes with the options below. We start off with the first line, which must be profit before tax. Because the question, profit before tax, is what we need to start off with. And the profit before tax was given to us in the statement of profit or loss. So if you go back to the statement of profit or loss given to us for the year ended December 2011, the profit before tax is 16,400. Okay? We'll use positive numbers to represent positive numbers, and we'll use negative signs to represent a reduction. So a profit here is a positive number, and therefore we start with a positive 16,400. $16,400. And I'm going to do that in green because I like everything to be color coordinated. That is your profit before tax. Now that you've done that, you need to do your adjustments. Now the format of the cash flow statement is so important that you need to remember it off by heart. These adjustments will be dealing with the non-cash items on the statement of profit or loss, and it will also deal with the working capital adjustments. Working capital is made up of your inventories, receivables, and your payables. So the examiner wants you to go through the statement of profit or loss and the statement of financial position, dealing with the non-cash items and the working capital adjustments. Okay, so I can go to my box here, my drop-down list here, and tick off things that I've already dealt with. Profit before tax. Okay, so please make sure you start off with profit before tax and not profit after tax. And the examiner has given you a massive clue here that you must start off with profit before tax. Okay, now we need to do the adjustments here. I'll start off with the adjustments for inventory. Inventory, receivables and payables are dealing with the working capital adjustments. So because I can see that as the first item on the drop-down list, I'm going to be dealing with that first. Adjustment in respect of inventories. Okay, now how would you do the adjustment for inventories? You need to compare the opening inventories balance to the closing inventories balance and decide, does this represent a cash inflow or a cash outflow? So let's go to the statement of financial position and highlight our inventories balance. At the start of the year, your inventory value was 18,608. But at the end of the year, your inventories balance is 22,732. Your inventories balance went up. How much did it go up by? Let's grab your calculators, please. 22,732 minus 18,608. This is 4,124. So your inventories balance went up by £4,124. Does that represent a cash inflow or a cash outflow? The cash flow statement is all about money in and money out. If your inventories balance went up, it means you've bought more inventory during the period compared to how much you've sold. So if your inventory's gone up, you've got more inventory in your warehouse, therefore you've spent a lot more money to have them there. And if you spent money, this will be classified as a cash outflow on the statement of cash flow. So 4124. So what I will do is put in there minus 4124. And this is a cash outflow. The next thing that I'm going to be dealing with is adjustment in respect of trade payables. Okay. The trade payables balances, you are going to again compare the opening balance to the closing balance and decide, has the payable value gone up or gone down? So let's scroll up to the statement of cash flow. There we go. Trade payable. At the start of the period, you owe your supplier £12,316. And at the end of the period, you owe your supplier £14,712. So your payables balance has gone up. How much has it gone up by? Grab your calculators and do the difference for me. 14,712, take away 12,316. And this gives me a balance of 2,396. This is 2,396. And if your payables have gone up, does this represent a cash inflow or cash outflow? If your liabilities have gone up, it means you've borrowed more money. And if you borrow more money, this can be classed as a cash inflow. But if your liabilities have gone down, it means you've paid off some of the money and therefore that's a cash outflow. So that would be an inflow of 2,396 to be placed in the statement of cash flow. So So that will be 2396. Okay, we leave it as a positive number to show money coming in towards us. The next thing we have will be the adjustment in respect of trade receivables. Okay, so let me just type that in there. Adjustment in respect of trade receivables. Okay, so I'll just go there. Your opening receivables is 15,162. Your closing receivables is 18,251. So the amount that your customers owe you has gone up. How much has it gone up by? Let's do the difference. 18,251 take away 15,162 gives you 3089. 3089. What cash flow would be presented if your receivables have increased? If your receivables have gone up, it means you are waiting a bit longer compared to what you've done last year in order to receive cash from your customers. If your receivables had gone down, it means the customers paid you some money and that will be an inflow. But if your receivables have gone up, you need to wait a bit longer and that will be cash outflow. So that will be a negative 3089. Negative 3089. Okay, so these items are your working capital adjustments. What else would go to the reconciliation of your cash flows from operating activities? Well, bank loans, this will be taken to your investing activities. Depreciation is a non-cash item, and these non-cash items on the statement of profit or loss will be reversed in the cash flow statement. So what we are doing is taking the profit before tax and eliminating any non-cash items. We are reversing what they would appear on the statement of profit or loss. So depreciation expense was given to us in this question, and let me just find it. There we go. It says in one of the notes that depreciation charge for the year was 4.992 million. Now, depreciation is an expense that is deducted on the statement of profit or loss. So in the cash flow statement, we reverse the effect by adding it back. So that'd be 4,992. So we have here depreciation, 4,992. Okay, so that's one of the adjustments. What other adjustments would we see in the cash flow statement? Finance cost. Yes, finance cost is a non-cash item appearing on the cash flow statement because it represents accrued interest expenses. The amount that you accrue doesn't necessarily mean that's the amount that you paid. So finance cost, whatever that was, is going to be calculated here. To find the finance cost, we need to ensure, are there any amounts accrued at the start of the year or at the end of the year? Look at your current liabilities section. With the current liabilities section, we can safely say that there is no interest accrued. In other words, there is no amounts at the start of the period and amounts at the end of the period. If there is no accrued interest expense, it means the amount of finance costs on the statement of profit or loss was the physical amount of cash that you paid. So here, the interest finance cost, that's 3,200. On the cash flow statement, we need to reverse its effect. So the finance cost is deducted on the income statement or the statement of profit or loss, so we reverse it by adding it back on the cash flow statement. So that would be a positive 3,200. Positive 3,200. Okay. What else would we have here? Interest paid. Well, interest paid, we'll deal with that later. Proceeds on disposal of PPE. No, this will go to your investing activities. Profit after tax, we've already established that that's not going to go there. Then we've got profit of disposal of PPE. Yes, A profit of disposal, this represents non-cash because the profit is the profit that you make. The cash that you received is the cash proceeds. So the profit of disposal of PPE is non-cash. Now this profit on disposal, this was calculated in the statement of profit or loss to be positive 139. So it was added on the statement of profit or loss. On the cash flow statement, we reverse the effect. So that's going to be a negative 139. That would be a negative 139. We're trying to eliminate any non-cash items, so the final cash inflows and cash outflows will be a reconciled amount between the starting balance and the closing balance. So grab your calculators, let's stop to calculate a total. 16,400 minus 4,124 plus 2,396 minus 3,089 plus 4,992 plus 3,200 minus 139. That will be 19,636. So these are cash generated by operations, 19,636. The next two lines you've got here is representing the tax that you pay and the interest that you pay. So the first one that we'll deal with here is the interest paid. The interest paid must represent the physical amount of interest paid. And since we said there is no opening accrual or closing accrual for interest, the amount shown on the statement of profit or loss is the actual amount paid. Okay, so interest paid, that is 3,200. If you pay your interest, this is going to be a cash outflow. So that will be a negative on the cash flow statement. Now the final bit here is going to be tax paid. The tax paid will represent the physical amount of tax that you paid, and you would only know about this if you learn the format of the statement of cash flow properly. To get tax paid, we need to check if there are any opening tax liabilities and closing tax liabilities. Here we go. Your opening tax is 4,120 and your closing tax is 3,270. How would we find out the actual amount that we paid? Well, we take the opening tax, which is 4,120. Then we add your tax expense. Your tax expense would be given to you on the statement of profit or loss, and this is calculated as 3,546. Okay, so that will be 3,546. Then you would stop to calculate a mini total. The mini total will tell you the total amount that you owe the tax authorities for this period, and that is 7,666. You will leave a line and compare this to your closing tax liability. Your closing tax liability is 3,270. So, during the period, the total amount that you owe the authorities is 7,666. But at the year end, the liability is only 3,270. Your liability has gone down. Why would your liability go down? Because you've paid some cash during the period. So the cash paid is going to be the balancing figure. So 7,666 take away 3,270, that will give me 4,396. Okay, so the cash paid or the tax paid is 4,396. So what I'll put there is minus 4,396. So if you grab your calculators to find out the net cash from operating activities, 19,636 minus 3,200 minus 4,396. This gives me a final figure of £12,040. There we go. That is 13 marks for this assessment, trying to get from the profit before tax to the cash generated from operations. This task is all about making sure you understand what will be a cash inflow, what will be a cash outflow. But it's also testing you of how to calculate the tax paid and how to calculate the interest paid. For these two items, always make sure you do the opening balance, add on the expense for the period, and you stop to calculate a mini total. That mini total is then compared to the closing balance, and the difference between the two is going to represent the tax or the interest that you paid for the period. Now, the next time we see each other, we're going to be filling in the entire cash flow statement. So we're going to be looking at the operating activities, the investing activities, and the financing activities. It's all about making sure that we show the examiner that we deserve as many marks as possible. We've got the knowledge, so we can apply the knowledge to real exam questions. Make sure that you understand the format of the cash flow statement, because that's what we're going to be doing next week. How do we deal with the cash proceeds from property, plant and equipment? What about the purchase of any property, plant and equipment? But also think about your non-cash items. Non-cash items would be your profit or loss on disposal, any bonus issue of shares, or any revaluation of assets. The cash flow statement aims to show a reconciliation between the opening and the closing cash and cash equivalent balances. So when we're ready to do the session next time, we're going to ensure that the opening balance will, minusing the cash inflows and outflows, will match the closing balance. So I thank you very much for joining me today. All the tutors here at LSBF wish you the best of luck with your studies. Until next time, take care.